Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in Accounting, and today our topic is, upon request, debit investment according to IFRS or IFRS number 9. So we have some very good difference here between the old standard, the IAS 39. So debit investments, two types of financial assets. Debit investment, our topic today, and equity investments that we will not be focusing here. So only debit investments, and motivation for investing earn a high rate of return to secure certain operating or financing arrangements with another company in case of equities. So we need to find two criteria for classification and measurement of financial assets. One, what is the company's business model for managing its financial assets? What are the contractual cash flow characteristics of the financial investments? So what do we have here? Debit investments are characterized by contractual payments on specified dates of principal and interest. And companies group investment into three categories, and here we have some changing in names especially. One, amortized cost. Two, FVOCI, or fair value through other comprehensive income. And number three, fair value recognizing profit and loss as they arrive, or FVPL. And let's compare IFRS number 9 and IAS 39. So here, amortized costs, FVPL, FVOCI. IAS 39, loans and receivable, FVPL, available for sale, held to maturity. So no available for sale, no held to maturity anymore. And measurement model, loans and receivables, amortized cost, FVPL, so fair value for profit and loss. Available for sale is the now FVOCI, fair value over other comprehensive income. And held to maturity is now the amortized cost. And how do we do that? A huge one, so I will stop here a little bit and you can read it. Amortized costs, amount recognized at initial recognition minus principal's repayment plus or minus the cumulative amortization of any difference between the initial amount and the maturity amount, and any loss allowance. Interest income is calculating using the effective interest method and is recognizing profit and loss. Changes in fair value are recognizing profit and loss when the asset is derecognized or reclassified. If it is not, no fair value at all. Fair value through other comprehensive income. So we have two measurements here. One for loans and receivable, that is our debit investments. The other one for equity, that is not our topic here. The asset is measured at fair value, period. Interest revenue, impairment gain and loss, and a portion of foreign exchange gain and losses are recognizing profit and loss on the same basis as amortized cost asset. So the interest rate. Changes in fair value are recognized initially in other comprehensive income. When it is derecognized or reclassified, we move it to the profit and loss. Just like here, derecognize it, we sell it. Then gain or loss on sale. So we move to profit and loss just like here. Fair value, recognizing profit and loss as they arise. Asset is measured at fair value, period. So interest, just like a regular interest expense, and changes in fair value are recognizing profit and loss as they arise. How do we choose them? So some summary. Is the objective of entities-based model to hold the financial assets to collect contractual cash flow? If yes, we go here. If no, is the financial asset held to achieve an objective by both collecting contractual cash flows and selling financial assets? No. I purchase today, I will sell it tomorrow. Fair value and profit and loss. But yes, is the objective of any business model to hold the financial assets to collect contractual cash flows? Yes, do contractual cash flow represent solely payments of principal and interest? If no, profit and loss, the old trading classification. If yes, does the company apply the fair value option to eliminate an accounting mismatch? What is this? I recognize everything based on fair value in profit and loss. There is only one that I don't. So it would give us a mismatch in our accounting or an accounting mismatch. So if yes, fair value in profit and loss. If no, amortized costs or amortized costs here. Or objective is to hold. So hold here is the old held to maturity. Then we can go through amortized costs. Or financial asset held to achieve an objective by both collecting contractual cash flows and selling. If yes, okay, I will collect the interest, but I will sell it soon. So do contractual cash flow represent solely payments of principal and interest, like bonds? That is our topic. Yes. Company apply fair value? No. So we don't apply it. So fair value through other comprehensive income. So the old held to maturity, the old available for sale, the old trading. And here's some reclassification from to amortized cost to fair value in profit and loss. We measure the fair value at reclassification date, and the difference between fair value and amortized cost will go to profit and loss. Fair value, profit and loss to amortized becomes the new gross carrying amount. So we just stop doing the fair value. Nothing, no adjustment is necessary. Amortized cost to fair value through other comprehensive income. The same as the first one. However, we recognize any difference in other comprehensive income. Fair value through other comprehensive income to amortized cost. We remove the gain and losses recognized in other comprehensive income. And we apply against the fair value of the financial assets. Then we go back to amortized cost. Fair value in profit and loss to fair value through other comprehensive income continue to measure at fair value, but subsequent gain and losses are recognized in other comprehensive income rather than profit and loss. The opposite, the same, but the cumulative gain and loss previously recognized in other comprehensive income is classified to profit and loss. So we recognize these gains. Okay, how do we do that? Let's go to our Excel file. And remember, all our Excel files are free. And the link to download it is in our video description. Let's see. Oh, we need to move some currency here. It was used based in US dollars. So let's move here to euro. The standard for my laptop is US dollar. So when I open it here now, it changes something. But here we are. Robinson SA purchased 100,000 euros of 8% bonds of Evermaster AG on January 1st, 2022 at a discount paying 92. We will check here how do we find these discounts. The bonds the bonds mature January 1st, 2027, so 5 years later, and yield 10%, so the market rate. Interest is payable twice a year, so it will be payable in 10 periods. So how do we find this number here? Face value, 100,000 euros. Bond rate, 4%. Why 4? 8% per year, 4% semi-annually. Same as the market rate. Period 10, semesters. This 4% here we only use for the cash payments of interest. That is $100,000 times 4%. So the carrying value or the fair value of this debit investment is a problem of present value. So let's insert the function here, present value. So rate, market rate. So from now on, market rate. Number of periods, 10 semesters. PMT is the interest paid semi-annually, so negative payments, 4,000 euros. FV, future value, is the principal that I will pay on January 1st, 2027. And then type blank because the first interest will be paid only at the end of the first period. So blank or 0. 92, 278, and 27 cents to be more accurate. So here, what is our journal entry? Debit investments and cash present value. It is different from the US GAAP. They have some discounts and premiums on bonds and quite complicated. So here, it's easier. This is our amortization schedule. So at the end of the first semester, our carrying value is our present value. Cash interest, $4,000 per semester. How do we find our interest revenue? Carrying value times the market rate or the interest revenue. So we pay or we receive here this investment 4,000 euros, but our revenue is 4,613. So the discount, that is the difference between face value and carrying value, is the difference between both. So our carrying value goes up, and it will go up and up and up, and after the 10th semester, it will be 100,000 euros. Now the interest revenue will go up because the carrying value will go up. What is our journal entry? We need to recognize cash interest, interest revenue, and discount amortized. So cash is our cash interest, 4,000. Interest revenue is the interest revenue here. The journal entry is not balanced. We need to balance it, and we need a debit to balance. So credit minus debit, 613. Let's go here on this gray. 613, our discount amortized. So our debit investment here, it is, whoa, sorry, I add everything in the wrong place. Okay, almost a live class here. 4,000, interest revenue for 613, and here the difference between both. So 613, 613. Here, at the end of the first semester, 92, the same 92 here. Second semester, December, the same, but with these numbers, and the carrying value must match the debit investment account. Okay, an asset account here. So, okay. Let's consider on December 31st, at the end of our fiscal year, let's consider our fiscal year ends on December 31st. Fair value, 98. January 10th, I sell it, 96. So amortized costs, December 31st, no journal entry at all. We don't work with fair value. January 10th, how do we do that? Cash, 96. Debit investment, recredit, this 93. Because we need to close this account. It is not balanced, we need a credit. Our cash is greater than our asset, so it is again gain on sale of investments, 2,463.21 euros. And here, gain, a regular gain on profit and loss. Easy, huh? As I tell to my students, easy and boring. Now, fair value recognizing profit and loss as they arise. The old trading classification. That is, by the way, this one here. Asset is measured at fair value. Any changes recognizing profit and loss. So, okay, for this interest here, it doesn't matter which classification we are working with. We do that. Some choose on this recognizing profit and loss. They don't recognize the interest revenue. They only recognize the fair value. So the fair value will be the sum of interest plus fair value. Others split it. I like to split it because it shows us better if this investment is a good one or a bad one. And some don't recognize it because it is quite a fast transaction, so you don't have time to even earn the first interest. Okay? So, fair value adjustment. How do we find these 4,000 euros here? Fair value, 98 minus the ending balance. 4,463.21 euros. And then gain on investment, unrealized gain, but on net income or profit and loss. Better. Oh, that was me. Come on. Format. No wrap test. Okay, much better. And then what do we have here? Now, January 10th, we sold it. How do we do now? Better. How do we do now? The loss is the difference on fair values. So, and then, it's the second here. The debit is not the investment. It's not the debit investment. It is fair value adjustment. It goes right together with the investment. Contra account or normal account. Why we don't combine it in the debit investment? To not lose the amortization schedule perspective. To not mess with this matching here. Okay? So how do we find now? Now we have a loss because our fair value decreases. So now we have a loss. So fair value adjustment, 2,000. And now, how do we record it? Easy. Sending it. Cash, 96. We need to close our debit investment. We need to close this account here, 93. We need to close this account as well. So it's here, but it will go through a circular reference here. So it's the number to balance, 96 minus 93. 2,463, close the account. Okay, and then on December 31st, as I told you, when we combine those two accounts, investment in bonds, 93, fair value adjustment for a total of 98,000 euros, our fair value. And the last one, the old available for sale, fair value through other comprehensive income. Exactly the same as the fair value recognizing profit. However, fair value adjustment, first one is exactly the same. However, the gain on investment, instead of profit and loss, it is other comprehensive income. It is on equity. And then the second one, the 2,000, the last one as well. However, the last one, we do two journal entries. So we do the first one, gain on investments. Here, because we are closing this gain on other comprehensive income, fair value adjustment, we are closing it. And then the gain on sale will be just like the gain on sale on the amortized cost. So it will be 2,463. So only in two, because if we don't do that, it will be missing some numbers here. If we do here this gain on here, it will not be good. So it will not be a very good journal entry here. It would be a huge and a mess one. So the first two journal entries, the first one to move from 98 to 96. The second one to close, to close the fair value adjustment and to close the gain. So we close both on this journal entry here. We are closing this one with this one, and that one with that one here. And then now we have balance only on investment minus cash, gain on sale of investment. So this one we are closing it, and when we sell it, we move from equity to profit and loss. So then the gain will be just like the amortized costs. And then we will be closing the unrealized or the unrealized gain and losses from other comprehensive income. So we are just moving from other comprehensive income to profit and loss, and the easiest way is close it on fair value, and then now we will move all of these fair values to the gain on sale. So we would be moving the first 4,000 gain, the second a loss, so we combine, it's nothing. So here we are moving this first gain minus this loss, so a gain of 2,463, they are here. Okay, guys, so thank you so much. Are you here? Questions or comments? Leave it here or email me at jscarping@gmail.com. Have a very nice day and God bless you.